I lost everything, thousands of dollars lost because of 3 little mistakes that almost all beginner investors make. In this video, I'll reveal how to invest in stocks, those 3 mistakes that lose your money, and an investing strategy so simple you won't believe it works. We're talking how to invest today on Let's Talk Money. Hey Bowtie Nation, Joseph Hogue here with the Let's Talk Money channel, and I've first got to send a special shout out to all you out there in the nation. Thank you for spending a part of your day to be here. If you're not part of that community yet, just click that little red subscribe button. It's free and you'll never miss an episode. Nation, let me take you back to 1999, and a fresh young Lance Corporal Hogue was getting to his first duty station. He saved nearly everything he earned during boot camp, and the rich Marine that he was, pockets overflowing with money. And if you've ever seen how much our enlisted warriors get paid, you know it's not much. Okay, so I knew the Marines were never going to make me a millionaire, so I had better invest that money, get it working for me, so I could retire to those sandy beaches someday instead of storming them in battle. And it was a great year to get started investing, right? Stocks in the NASDAQ were up 85% by the end of the year, and the only question was whether I wanted a 2-story beachfront condo or something bigger. But you already know how the story played out. I lost nearly everything over the next year. My faith in the stock market as easy money was shattered, and it took years before I got back into stocks. Nation, the fact is, making money in stocks is actually pretty easy. Stocks have tripled in the last decade for almost a 13% annualized return. Now that's without doing any stock picking, without finding those best of breed names that we talk about on the channel, just investing across the broader stock market. Now the question everyone should be asking though is, how do I not lose my money in stocks once I've made it? And think about it, investing just $100 a month at a 15% annual return means having over $500,000 in 30 years. Now that's trading 1 cup of coffee a day for $521,000 and simply putting that money in stocks. That's not what happens, is it? The average investor makes between 2 to 4% a year, according to an annual survey by Delbar Research, because they make all the worst investing decisions. They fall into those same investing mistakes that I made, oh, so many years ago. In this video, I'll show you those 3 investing traps that every new investor makes, as well as how to invest the right way. I'll then reveal my favorite investing strategy, one that's going to take the stress out of investing and will make sure that you keep making money. And believe it or not, this is actually the perfect time for this video. Now everyone wants to ask this question, how not to lose money after the stock market has already started crashing. Instead, why not start before the panic, before the next stock market crash wipes you out like it did me? So my deal to you, give me 10 minutes and I'll help you protect your hard-earned money. Now let's get to those 3 mistakes and how to invest in stocks so you don't lose your money. But first, I want to get your input on this. What has been the biggest mistake that you've made in investing? What's that one do-over that you wish you could have? So scroll down and let me know in the comments below, what's that investment that you wish you could do over? The first lesson on how to invest is to limit the amount you have in any single stock to 5% or less. Investors love to get emotional about shares of a company. Just ask any investor what they think of Tesla or Apple or their favorite dividend stock, and God help you if you say something bad about it. But the problem is they have a tendency to go all in on these stocks. How many times have you heard someone say, I've got all my money in tech stocks, or I just put 30 grand in Tesla ahead of its earnings? And you might not even realize it until it's too late. You buy into a company and get really excited about it, but the share price starts dropping. No worries, you buy another chunk to dollar cost average your investment. Now the shares only have to rebound a little for you to make your money back and then some. What happens though is that before you know it, you've got 20 or 30% or more of your money in this single stock. And this was my biggest mistake in 1999, having nearly everything I owned in just a few high-flying tech stocks. If I had spread my money out across funds or some other stocks like in the strategy that I'm going to reveal later, those losses wouldn't have been nearly as bad. Limiting the money you're going to invest in a single stock means avoiding those apocalyptic losses where you wipe out years of gains. So the lesson I learned is 5%. No more than 5% of my wealth in any single stock. For example, this means that I might start my investment with 2%. So if I have $100,000 in stocks, I might invest 2 grand in the stock to start off with. That's going to leave room, that remaining few percent to the 5% limit, to buy more of the stock if I want a dollar cost average lower. But you have got to stick with the rule. If you keep buying and hit that 5% limit in a single stock, it doesn't matter how much you love the company, do not buy a single share more. And I know this seems like it's going to limit your gains in winning stocks, but please believe me, this rule is going to save your Ignore it, and eventually you're going to chase that losing stock all the way down and lose tens of thousands of dollars, wiping out a big chunk of your portfolio. Another investing lesson I learned the hard way is to always evaluate a stock on its future potential, not what it's happened in the past. Nation, I see a lot of new investors out there chasing stocks purely on looking at the rise in shares over the past year, reasoning that if a stock price is going up, it must be a good investment. Now, there is a strategy called momentum investing, where you invest based on a technical analysis and the patterns in a stock, but it's on that analysis, not just that the stock price has been going up. I know this is a tough one because it's so much easier to just invest in the stocks you hear about on the news or online, the ones that are already going up. Who has the time to spend hours a month or even each week to actually analyze a stock to find the best investments? But this is the same trap investors fall for before every single crash. In 1999, when I was starting to invest, it was the assumption that all internet stocks were going to change the world. That analysis didn't matter. All you had to do was invest in what's going up. Now, I promised to keep this video to about 10 minutes, and I want to get to that simple investing strategy next. But I'm going to link in the description below to my 7-step process for analyzing a stock. Make sure you watch that one next. It's an exact start to finish process for picking stocks that I developed as an equity analyst, and it will make you a better investor. Now, another big mistake investors make is seated in what's called the loss aversion theory, a subconscious avoidance of even acknowledging losses or mistakes. So have you ever been down so much in a stock that you just didn't even want to look at your portfolio? Have you ever held onto a stock despite losing 20 or 30% because you just didn't want to take the loss? Nation, you cannot get hung up on how much you paid for a stock or even how much you've lost. If you thought those shares of the $10 stock were going to 15, but then that new information came out to affect your reasoning, you have to look at those shares again and honestly decide if you still want it in your portfolio. And I know it sucks to take that loss on an investment, but you have got to constantly be reevaluating your stocks with all the current information, both the good and the bad. If the shares are no longer a good investment, if that upside potential no longer meets your return requirement, then you need to look for a better investment. And this doesn't mean sitting in front of CNBC or your investing platform 24 hours a day. Barring any shocking headlines, you can reevaluate your stocks once every 3 months after earnings are reported. In that strategy I'll share later, I'll show you how to make this as easy as possible and less time consuming, going back to analyzing your stock picks. The point is though, it's not how much you paid for a stock. It's not the price targets analysts had on the shares when you bought it. Whether you've lost money or not, none of this has anything to do with keeping that investment. The only thing here that matters is that impartial assessment of the future stock price and whether that growth is enough to hold the investment or something else. The third lesson on how to invest before we get to that bonus investing strategy is always have a defined point when you're gonna sell a stock. This one ties in with the last rule to help you avoid holding those losing stocks as they burn your portfolio to the ground. And selling those losers is one of the hardest things to do, and part of it is because of the shifting expectations. For example, maybe you buy that stock at $100 and expect it to go to $150 a share. Then the shares fall though to $80 each, and now maybe you only think the fair value is $105 a share. Now that's not much above what you bought it for, but it's still a 30% increase from the new lower price. So when you do buy a stock, bullet point out all the reasons down to your target price and competitive advantages the company has over its peers. Then add in your notes to a set of reasons that you might sell the shares. This is all going to help you avoid that idea of shifting expectations. If one of your rules is that you sell a stock that has lost 15%, then that takes all the risk out of the decision. It reduces the possibility to zero that you're going to follow any stock down to bankruptcy. For example, if you write out one of your reasons for investing in a stock is because of a big potential in a new project, and the company ends up scrapping that project, then that avoids you looking for an excuse to hold on to those shares. You've formalized your reasons for buying the shares and what it would take to make you change your mind. It takes all the guesswork out of investing and keeps you from making some of those big money-losing mistakes. Now I want to share that bonus investing strategy with you, a strategy that's going to make investing as stress-free as possible and the one that I use for my portfolio. The core satellite strategy is where you put 40 to 60% of your money into broad funds or ETFs. We're talking about ETFs and funds that cover the asset classes like stocks, bonds, and real estate. Maybe you invest in a fund of dividend stocks or one with international companies. And these funds are going to give you those market returns. Diversify your portfolio for that smoother ride. Then you take the rest, that 50% or so of your money, and invest in a small handful of individual stocks, maybe 7 to 12 or 15 stocks. And by limiting your portfolio to less than a dozen stocks or so, you solve a lot of the problems that lose investors money. You're not constantly looking for new stock picks. That's going to save you hours. Plus, it means you're only going to be investing in the very best stocks you find. It also makes it much more practical to keep up with your stocks, keeping up with the research and where the company is going. That's something you just can't do if you're investing in 20 or 30 companies or more. Using these lessons for investing in stocks along with that core satellite strategy, and you will avoid making the worst of those investor mistakes. You'll get those market returns plus the instant diversification from your core part of your portfolio. You'll get the potential upside for a few extra percent return on those handful of individual stocks, and you'll know when to sell to avoid losing money. Click on the video to the right for that step-by-step to investing in stocks, a complete guide to analyzing any stock. Don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification.